Welcome to this wonderful topic one more time. Question number 2, cell practice. Right first, very important, because similar questions have been asked in the exam recently also. Very important. Question number 2, cell practice. Below your cell practice 1, which we solved previously, it is a 10-mark question. XYZ Limited is an export-oriented business house in Mumbai. The company invoices in customer's currency. So the invoice will be in the currency of the customer, and this company is located in Mumbai. So home currency is rupees, and it is an export problem. Its receipt of US dollar 1 lakh is due on September 1, 2005. So what is the problem? This company has to receive $1 lakh on 1st September 2005. Market information as at 1st June 2005. So today is 1st June 2005. The proceeds will be received on 1st September 2005. So after how many months? July, August, June, July, August. September I will not count. So 3 months, June, July, August. And what is the information available on 1st of June 2005? Read the problem carefully. Here it is written exchange rate, and then there is another column for currency future. Now the question is going to test your understanding, because the exchange rate is given as US dollar per rupees. US dollar per rupees. For 1 rupees you can exchange so many US dollar. Spot rate is 0.02140. Spot rate is 0.02140. Spot will be of no use to us, because the transaction will be settled on 1st September. Then 1 month forward is also of no use to us, because it's a 3-month problem. So therefore these two information are given just to test you whether you understand it or not. 3-month forward rate, this is relevant, tick mark. So 3-month forward rate, because the amount will be received after 3 months. So I will enter into a 3-month forward contract, and it is US dollar per rupees. This is the exchange rate. This is the quotation for 3 months forward. Now come to this part. This part is for future. Currency future is available. Contract size. Now underline or put it in a square. The currency size is given in rupees 4,72,000. So how do you interpret it? That future is available for rupee. Future is available for rupee. So it is a rupee denominated future. So to calculate the number of lots, this is 1 lakh US dollar. This you will first convert using future rate. Here also 2 rates are given, June and September. June is not relevant. We will enter into a September future contract. This is relevant. So some cross mark which I have done, they are not relevant at all in our problem. So number of future contract to be taken will be now, this is 10 lakh dollar, and this is the future rate, which is dollar per rupees. So you'll have to divide 0.02118, and again you will divide by 1 lot, 4,72,000. So this will give you number of lots, and this is the future rate, dollar per rupees you will lock. Then what they have given, initial margin and interest rate. June initial margin 10,000, not relevant. Why? Because we are going to enter into a September future contract. For September future contract, the initial margin will be 15,000, and on initial margin we will calculate interest at the rate of 8% per annum. This is per annum, even though per annum is not written. So the purpose of giving initial margin and interest rate is to calculate the interest cost due to money blocked in initial margin. So that is 15,000 for one contract. Here we will get number of contracts multiplied by number of contracts, which will be rounded off, and then multiplied by 8% and then multiplied by 3 by 12. It's a 3 months problem. So that will give you interest cost on initial margin money. Now what happens on maturity? On September 1, 2005, the spot rate US dollar per rupees 0.02133. This is the rate at which you will convert your export proceeds in the spot market on maturity, and the currency future rate is 0.02134, and this is the rate at which your future contract will be squared off. Your future contract will be squared off, and the difference between these two will be your gain or loss. Difference between these two rates will be your gain or loss multiplied by number of future contracts and multiplied by lot size. So that will give you gain or loss. That I will not tell you right now. That I will ask you at the time of solving the problem. Comment which of the following method would be most advantageous. Option A, forward. Very easy. You will take this rate, and this is $1 lakh. So $1 lakh converted at this rate is your first answer. Second is using currency future. That is what we have discussed. Under currency future, we will receive $1 lakh converted at spot rate, gain or loss on future, and interest cost on margin money. So 3 items I will calculate, take the net amount. That is my inflow under future. And not hedging currency risk means, not hedging currency risk simply means you will just receive $1 lakh and you convert at the spot rate on maturity. That is your answer under not hedging the risk. This is a problem of exporter. The objective is inflow maximization. So that alternative which gives me higher inflow in rupees will be the most advantageous. And the last line says it may be assumed that variation in margin would be settled on the maturity of the future contracts. So whatever is the variation in margin, because as you know, in case of future contract, you have to pay mark to market margin on a daily basis or receive on daily basis. But to keep the story simple, the difference will be settled on maturity. The difference between these two figures we will settle on maturity. So let us start similar to previous question, and this time one more adjustment is given, initial margin, interest cost on that. Otherwise the problem was simple. So first you write down alternative 1, enter into 3 months future forward contract, forward. Now in this question, forward is different, future is different. Forward is over the counter, customized contract, whereas future is standardized contract, traded on the exchange. Now write down right hand side amount. Right hand side amount, first point number A, amount receivable in dollar. How much dollar? First paragraph, $1 lakh, and there are spot rate given, 1 month forward rate is given, 3 month forward rate is 0.02127. You have to just type it on the left side. So 3 month forward rate dollar per rupee is 0.02127 dollar per rupees. This is in dollar, this is dollar per rupees. So what will you do? You will divide amount receivable after 3 months in INR, amount receivable after 3 months in INR, A by B, 47,01,457. 47,01,457. So this is the answer under forward. Dollar amount is given, rate is given, just convert it. This will be your inflow if you book a forward contract. Forward is always easy to solve. Now the difficult part is future contract, because there are so many variables: contract size, future rate, maturity rate, initial margin, interest on initial margin, and all this. So you will write option 2 or alternative to future contract. Future contract, write a note. Now first of all, you have to understand what is the risk. If you are an exporter, the risk is either dollar may depreciate or rupee may appreciate. Dollar may depreciate or rupee may appreciate. Then you have to see future contract is available in which currency. Future contract is available in rupees. Rupee is expected to appreciate. So what is the position in the future market you will take on a future contract which is denominated in rupees? So if you think that the price of underlying is going to go up, the underlying is going to become more expensive in the years to come, days to come, then you should buy future. So if the rupee really appreciates, there will be loss on converting dollar into rupees on maturity, but there will be gain on future. Gain on future to some extent will compensate for the loss on converting dollar into rupees on spot on maturity date. So with that knowledge, now I will present the answer neatly. So write a note: the firm is afraid of dollar falling. This line is applicable to all the exporter. Foreign currency will depreciate, that is home currency rupee may appreciate. Futures are available for rupee. Futures are available for rupee. It should buy rupee because rupee is expected to rise. So in case of future and forward market, we should buy in future or forward market if the underlying is expected to rise. So buy rupee future of September maturity. They have given you June maturity also, but I will not take a future contract which will expire before my exposure is settled. So I will take it September maturity. And what is the rate for future available in the market? The future contract is available at $0.02118 per rupee. Since the receivable is on 1st September, why we have taken September, why not June? The response to that query: since receivable is on 1st September, the firm should choose the September future contract. The future contract should expire after the date when you receive the payment, not before that. So September is relevant, June is not relevant. And now the problem will be solved exactly like your previous problems. First we will find out, because the future is available on rupee, the lot size is given in rupee, I need to find out rupee equivalent of dollar exposure. So step number 1, rupee equivalent of USD exposure, and for that you will apply this rate, the future contracted rate. $1 lakh divided by 0.02118 is equal to rupees 47,21,435. 47,21,435. Then write down step 2, number of contracts. Number of contracts will be 47,21,435 divided by 1 contract size, which is 4,72,000, and that is equal to round off 10 contracts. 10 contracts rounded off, you are getting 10 point something. Contracts can be in whole numbers only. So that will be required for calculating gain or loss. That will be required for calculating the initial margin, interest, cost also. Now step number 3 will be profit on squaring of future on 1st September. Profit on squaring of future on 1st September. So we have bought future at 0.02118. In the month of September, last few lines, the currency future is trading at 0.02134. So in order to square off, I will have to sell future at this rate, buy at this rate, sell at this rate. So you can understand selling rate is more than the buying rate. Selling rate is more than the buying rate. So that difference will give me profit in dollar per rupee. So the difference is so many dollar for 1 rupee multiplied by lot size multiplied by number of lots. So many rupees will give me profit in dollar terms. Your answer will come in dollar terms. So here we have to be careful when you solve the problem. This profit will come in dollar terms because the profit is dollar per rupee. So much dollar profit against so much of rupees. So write down, we are going to make profit because as I said earlier we had bought, to square off we will sell rate is more. So the difference is profit into, in one lot 4,72,000 rupees multiplied by 10 lots. So the answer will be $755.2. $755.2. Be careful about the currency dollar because students sometimes write rupees here. Step 4, total amount available after 3 months. Total amount available after 3 months. Total amount available after 3 months. 1 lakh you will receive from the customer and 755.2 you will receive from the profit on future. So total dollar available after 3 months will be 1 lakh received from customer, 755.2 from the counterparty to the future contract. So therefore now I have $1,755.2. This dollar I will sell in the spot market on 1st September. So on 1st September in the spot market, the rate is US dollar per rupee 0.02133. So at that rate, we will convert these dollars into rupees. So write down $1,755.2 will be sold spot at 0.02133. Therefore, inflow equal to, we will divide it because this currency is in dollar, rate is for rupees. So write down this number in the numerator, divide by, in the denominator write 0.02133. 0.02133 divide. So now you have 47,23,638 rupees. This has taken into account that 1 lakh dollar as well as the profit on future. Two things have been covered. One is still pending. What is that? Yes, interest on initial margin blocked for 3 months. Interest on initial margin blocked for 3 months. So your initial margin is 15,000 rupees per contract into 10 contracts multiplied by rate of interest for September future is 8% per annum into 3 by 12. Time is 3 months. 3 by 12. Take your calculator, solve this. Solve it. Give me the answer. So the answer is 3,000 rupees. The answer is 3,000 rupees. And now step number 7. Net inflow on 1st September. Net inflow on 1st September. Net inflow on 1st September will be, this is my inflow which covers $1 lakh plus profit on future, and then this minus 3,000. So we will get 47,20,638 rupees. So if I use future contract, this inflow will be 47,20,638. Look at the answer. It is so easy once you start understanding. And then there is one more alternative 3. No cover. No cover. If no cover is given, how do I calculate the rupee inflow? Will I take the current spot rate or will I take the spot rate on maturity? So I will take spot rate on maturity. Right hand side amount, point number A. Amount receivable in dollar. Amount receivable in dollar 1 lakh. Point B, 3 months forward rate. 3 months forward rate dollar per rupee. 3 months forward rate dollar per rupees. Actually it should not be forward. 3 months spot rate. Spot rate. 3 months spot rate, last 3-4 lines of the question. On September 1, 2005, 3 months spot rate dollar per rupee in bracket on September 1. On September 1, that is 0.02133. Now write down amount receivable after 3 months. Amount receivable after 3 months. A by B in INR. A by B in INR. So take your calculator, 1 lakh divide by 0.02133. Check the answer with me. 46,88,233. 46,88,233. Now I have all the 3 answers ready. Compare the 3 answers and check under which alternative you are getting highest rupee inflow. So the answer is under future contract. So write down here decision, future is preferable. Future is preferable because rupee receipts is highest. Future is preferable because rupee receipts is highest. Since the rupee receipt is highest under future contract, it should be preferred. This way you can write. Based on whatever information is available, this is the answer that we need to arrive at. One more question we will practice. Similar problem drafted in a different way. Similar question. Come to question number 16. Question number 16, sale practice. More and more practice will help you so that you will understand which rate to be taken, whether to multiply or divide, what position in the future market to be taken, how to calculate the initial margin interest cost, how to calculate the net cost. So I need to do some more practice with you. Write down or come to question number 16 in self practice. This is an exam question for 6 marks in May 2015 exam. And as you can see, this is similar to the one we solved, almost a replica of what we did just now. Only they have changed the numbers. EFD Limited is an export business house. The company prepares invoice in customers' currency. Its debtor of US dollar, this time 10 million, 1 crore, is due on 1st April. Market information on 1st January is, so count January full, February full, March full. So 3 months. So this is a problem where you will receive $10 million after 3 months from the customer, and these are the information on 1st of January. Exchange rate, again to confuse you, USD per INR is given. So rate is for INR. Spot rate, 1 month forward rate, 3 month forward rate, and this side the detail is about currency future. Currency future US dollar per INR. And look at the contract size. The contract size, it is in rupees. So what we will do, we will interpret this as future is available on which currency? Future is available in rupees, because rupee contract size is given. Problem, but the figures this time are quite bigger ones. 1 month, 3 months. So again I will ask you to first cross irrelevant, irrelevant, irrelevant. These 3 numbers are irrelevant. 3 month forward is relevant, 3 month future is relevant. Then initial margin 1 month is irrelevant, 3 months are relevant. On 1st April 2015, that is, this is the maturity date. This is the maturity date. The spot rate US dollar per INR is 0.01636. This is relevant for converting dollar into rupees, and currency future rates are 0.016134. This is for calculating the gain or loss on future contract. Which of the following methods would be most advantageous? Forward, future, no hedging. So this is nothing but a copy paste version of your previous exam, that was 2006 exam, and then again the same problem in May 15 after so many years. So first we will write down alternative 1. Same discussion, one more practice. Enter into 3 month forward contract. Enter into 3 months forward contract. Right hand side amount. First point A, amount receivable in pound, dollar. Amount receivable in dollar, be careful, it is 1 crore. 10 million is 1 crore. Sometimes the student make mistake in these zeros also. I have seen 3 month forward rate. Forward rate will take 3 months, not 1 month, because you are going to receive the money after 3 months. So dollar per rupees 0.016129, 0.016129, 0.016129. Then C, amount receivable after 3 months. Amount receivable after 3 months. This is dollar, this is per rupee. You will divide, check the answer. It will be a big amount. 62 crore 1250. Write carefully. Purposefully I am practicing such question, because sometime the student make mistake even in calculation here. He might just write down 6 crore. Some of you even write 62 lakh also. Amazing. And some of you multiply also. By converting 1 crore dollar, you get 16 lakh rupees. Unbelievable. Now write down option 2, future contract. Same discussion. You are an exporter. Dollar may depreciate or rupee may appreciate. That is your risk. Check the future availability. Future is available on rupee. Rupee is expected to appreciate, that is the risk. So in that case, you will buy future on rupee. You will buy rupee future contract. So if the rupee appreciates, there will be loss when you receive the dollar and convert into rupees, but there will be gain on the future. The gain on future will compensate for the loss in rupees in spot market. So write a note. Same discussion, same problem. Note, write down the firm is afraid of dollar falling, that is rupee rising. You have to write the note in the exam also. Futures are available for rupee. Futures are available for rupees. It should buy rupee future of April maturity. It should buy rupee future of April maturity at $0.016118 per rupee. At $0.016118 per rupee. And why we will take April contract? Why we will not take January contract? Since receivable is on 1st April. Since receivable is on 1st April, the firm should choose April future contract. The firm should choose April future contract. Right. So whenever you will read your own answer, it is so easy to understand now. Always take future contract which will expire on or after your exposure maturity date. You are going to receive payment on 1st April. So choose a future contract which will mature on 1st April or after that. Step number 1, rupee equivalent of USD exposure. Rupee equivalent of USD exposure. This time you write down here 1 crore. 1 crore divide by this rate 0.016118 and you will get rupees. This is 62 crore 4 lakh 24,371 rupees. These many rupees we have to hedge, and one lot size is given to you. Contract size 2 crore 48 lakh 16,975. So that will help us to get the number of contracts. So step 2, number of contracts. Type on your calculator 620424,370 and divide by 248,16,975, 24.999. So this is okay, 25 contracts. You can write rounded off because 0.0001 we are rounding off. Now use that number for calculating profit and calculating initial margin cost, interest on that. So profit on squaring of future. You have bought future. First we'll discuss. These are very small numbers, so reading them also is important. And now on the 1st April, the currency future is trading at 0.016134. So what I will do, I will square off by selling. If you have written bought here, you have to write sell here. So still there is some positive gain here. So there will be gain because this sell is more than buy. Gain will be in dollar per rupee. So therefore your answer will be finally in dollar. Write down now. 0.016134 minus 0.016118 that is for 1 rupee, multiplied by 1 lot. In 1 lot we have 2, 4, 8, 1, 6, 9, 7, 5 rupees, multiplied by 25 lots, multiplied by 25 lots. So that will give me answer which is in dollar. Be careful about the currency here, because students write rupees here sometimes. Now write down step 4, total amount available after 3 months. We are exporter. 10 million I will receive from customer. 9926.79 I will receive from future contract counterparty gain. So my total dollar available on 1st April will be 10 million, 1 crore, 10 million or 1 crore plus 9926.79. Both figures are in dollar. So add it. You will get 1 crore 9,926.79 dollar. What will you do with this dollar? You are an Indian party. You will convert into rupees at what rate? At spot rate on 1st April. At spot rate on 1st April. Look at the question. Last 3 lines. 0.016136. So write down step 5. Rupee inflow after 3 months. Rupee inflow after 3 months. So you will write this figure, dollar 1 crore 9,926.79 will be sold spot at 0.016136. Therefore write down, therefore rupee inflow equal to, take this amount, divide by, in the denominator divide by 0.016136. 0.016136. Take your calculator, do it carefully. Look at the numbers, write properly. 62 crore 3 lakh 47,470. Last digit can be rounded off here. Answer is not over because initial margin is also given. If initial margin is also given, we will calculate interest on initial margin blocked for 3 months. We will calculate interest on initial margin blocked for 3 months. So write down 22,500 into 25 lots. We will take the 22,500 figure, that is 3 months 22,500. Do not take 1 month 17,500 because we are entering into a 3-month maturity future contract, and you remember we have bought 25 lots. We have bought 25 lots into 7%, which is the interest rate given. Time is 3 months. Suppose in your exam the time is 2 months, you write 2 by 12. This is not to be remembered. It is as per the question. This interest rate as per the question. Lots we will calculate, and this is as per the question. So the answer is 9844. This is outflow if you want to write. This is always outflow, and this is inflow because we are exporter. So my net rupee inflow will be step 7, net rupee inflow on 1st April. Net rupee inflow on 1st April is equal to, take 62 crore 3 lakh 47,470 and minus 9844. Minus 9844. Take your calculator, write down the calculation, check the answer with me. Are you getting 62 crore 3 lakh 37,626 rupees? This is the answer under future contract. We are following wherever possible a similar way of presentation, it will become easier for you to present in the exam also, because you know what are the steps I have to follow. Don't remember, just understand so that you can do it yourself. Now write down alternative 3. No cover. If no cover means whatever is the expected spot rate on maturity, that will be applied. So write down option 3. No cover. Right hand side amount. First point A. Amount receivable in dollar. Amount receivable in dollar. 1 crore. Then write down 3-month spot rate, or you can write spot rate after 3 months. Spot rate after 3 months, that is 1st April. That is 1st April, and in bracket dollar per rupees. Dollar per rupees is 0.016136. 0.016136. 0.016136. Then write down amount receivable after 3 months. Amount receivable after 3 months. A by B in Indian rupees. Check the answer. 1 crore divided by this number. 61 crore 97 lakh 32,276. Is this right? Compare forward, future, no hedging. See which figure is highest. Which figure is highest. So you will write again the same decision. Coincidentally, future is preferable. Future is preferable. If it is a inflow maximization problem, select the alternative which has higher rupee inflow or home currency inflow. So future is preferable because rupee receipts is highest. Because rupee receipts is highest. Rupee receipt is highest. One more question we will practice. May 19 problem, question number 23. You just turn the pages. Last few pages. Question number 23. May 19 exam. One more chance to you to understand future problem. Please come to question number 23. Self practice May 19 exam. Ready? Question starts with DSE Limited is an export oriented business house in Kolkata. Underline export oriented. Now in the next exam they might change it to import problem. You have to reverse everything, your calculations. DSE Limited invoices in customers' currency. Its receipts of US dollar 3 lakh is due on 1st July. So underline 1st July. Market information on 1st April. So the number of months will be April, May, June. Don't take July. So it's a question of 3 months. In every exam you please check this. The question may look similar, but they might just make it 1st August. So it will become a 4 months problem. So 3 months coincidentally in all the 3 questions that we have solved. It was 3 months. Exchange rate dollar per rupees. Again dollar per rupees. So institute is taking previous year question, changing the figures, okay, here and there, and formulating a new question. It seems spot rate cross not relevant. 1 month not relevant. 3 month forward, yes, relevant. Currency future US dollar per rupees. April not relevant. July relevant. And contract size is in rupees. Contract size is in rupees. So therefore, we will say future is denominated in rupees, because this confuses the student. So purposefully they do it to extract money from the student. And then initial margin, interest rate. April write down, not relevant, because we are entering into future contract which will expire in July. So 24,000 and 8.5% is relevant. On July, which July? It should be 1st July. Anyway, it seems they have missed this first word here. On 1st July, the spot rate US dollar per rupee, it is rupees here, dollar per rupees is 0.016146. So that will be the rate at which we will convert dollar into rupees. And currency future rate, this will be required for gain or loss. Comment which of the following method would be most advantageous for DSC Limited. Forward, future, no hedging. And the last line again copy paste. It may be assumed that variation in margin would be settled on the maturity of the future contract. So all this gain or loss in future, that is difference between 0.0147 and 0.0151, this difference they will settle on maturity. Practically there is a mark to market margin concept. So daily difference is received or paid. Now dear student, please write alternative 1. Enter into 3-month forward contract. Enter into a 3-month forward contract. Enter into a 3-month forward contract. Enter into a 3-month forward contract. Serial number, particulars, rupees. Serial number, particulars, rupees. Point A, amount receivable in dollar. Amount receivable in dollar. $3 lakh. 3-month forward rate. 3-month forward rate. Dollar per rupees. 0.0147. Look at the question. This is May 2019 question. Very important. Amount receivable after 3 months in rupees. What will you do? Multiply or divide? Divide. So please divide on your calculator. 3 lakh divide by 0.0147. You will be getting 2,04,08,163. 2,04,08,163. This is your first answer. Now let us see the position that I need to take in the future market. Same discussion, I'll repeat. Exporter has two worries. Either of the two worries, that dollar may depreciate, which means rupee may appreciate, and the future is available on rupees. So we will buy rupee future. We will buy rupee future. If the rupee appreciates, we will lose on converting dollar into rupees on maturity, but we will gain on future. Gain on future compensates for loss on actual conversion of dollar into rupees. So start with a note. The note says the firm is afraid of dollar falling. The firm is afraid of dollar falling. That is rupee rising. That is rupee rising. Futures are available for rupee. futures are available for rupees, it should buy rupee future of July maturity. It should buy rupee future of July maturity at $0.0151 rupee per rupee, $0.0151 per rupee. And why we have entered into July, not April? I have written a reason for that. Since receivable is on 1st July, the firm should choose July future contract. Receivable is on 1st July, the firm should choose July future contract. So write down step 1. You are going to receive $3 lakh, but the future is denominated in rupee. So you will find out what is the equivalent amount in rupee which you need to hedge. So rupee equivalent of USD exposure. Rupee equivalent of USD exposure. 3 lakh divided by 0.0151. That is rupees 198,67550. 198,67550. Now write down step 2. Number of contracts. Number of contracts will be 1,98,67,550. Look at the question. In a small box they have given contract size. Contract size 6,40,000. So take on your calculator 198,67,550 divided by 6,40,000. So you are getting 31.04. Round off to 31. Round off to 31. So 31 contracts in bracket to be bought. 31 contracts to be bought. Now I wanted you to try now the remaining part of this future contract problem and give me the net cash inflow after 3 months. So remaining steps the student will try. Come on, start solving. Calculate gain or loss, calculate rupee received, calculate interest on margin, calculate final net inflow under future contract. So this is your class work. This is your class test. So come on, try. Please try. Just copy the previous format and you have to change the numbers. At least you will also get a practice on your own. Now you will have to think which number I should take. Is it a profit or loss? Do I need to multiply or divide? Etc. So please try. Think it as a class test for 5 marks. Those who have completed future, why don't you go to no hedging? Try that also. Please do it fast. Do it fast. 5 seconds more now. We are going to check the answer very soon. You have to present the way I have presented. Okay, time over. Now we'll check the answer. Number of contracts we have computed. Step number 3, loss on squaring of future on 1st July. Sir, it is a gain. How is it loss? In all problems it was gain, but this is loss here. Now understand why it is a loss. You have bought future at 0.0151 and you have sold future at the time of squaring of last few lines of the question 0.0147. Bought at a higher price, sold at a lower price. So there is going to be loss 0.0004 dollar per rupee loss. So this time what the institute has done, it has changed this, and many students might have written profit, and therefore your whole answer of future will go wrong. So if it was an 8-mark question, you might lose 4 marks. So the answer is 0.0147 minus 0.0151. This rate is less this time, into 6,40,000 into 31 lots. So negative $7936. The company has to pay the difference. Even in your answer printed below, they have also made the same mistake. They have also taken into account the profit. So total amount available after 3 months. Total amount available after 3 months. So this time it will be 3 lakh you will receive, and out of that $7936 will be paid as a loss under the loss under forward contract, future contract. So you are left with $292,064. You are left with $292,064. Then write down step 5, rupee inflow after 3 months. This dollar I will sell in the spot market. Spot market rate is 0.0146 on maturity. So $292,064 will be sold at 0.0146. Convert into rupees. Inflow equal to rupee inflow equal to $292,064 divided by 0.0146. That will give me rupees 2 crore 4,384. 2 crore 4,384. Step number 6. Step number 6. Interest on initial margin blocked for 3 months. Interest on initial margin blocked for 3 months. That we have discussed. We'll take July figure. In July we have 24,000 rupees margin for July contract. Number of contracts 31. Multiplied by interest rate 8.5%. All these figures are given. Only this figure I have to take from my calculation. So the answer is 15,810. This is outflow. This was inflow, already written inflow. So what is my final answer here? Net inflow on 1st July. Net inflow on 1st July. Write the calculation. 2 crore 4,384 minus 15,810. Come on, solve. This comes to 1 crore 99 lakh 88,574. This answer is not matching with the printed answer because even the institute has made this mistake. They have treated this as profit instead of loss. One more choice we have. No hedging. Alternative 3, no hedging. Right hand side amount. Point number A. Amount receivable in dollar 3 lakh. Expected 3 months spot rate dollar per rupees. Expected 3 months spot rate dollar per rupees 0.0146. Last 3-4 lines in the question. This number is required at two places. One for converting dollar into rupees under future contract, and then under no cover also, unless some other information is given. Amount receivable after 3 months. A by B in rupees 2,05,47,945. So check the highest receipt. Where do you have highest receipt? So if I look at the numbers, the highest receipt is under no hedging. You can see, if you look at our answer, no hedging has the highest rupee inflow. Institute answer is future because they have made some mistake in the calculation. No hedging is preferable because rupee receipts is highest. This way we will write our conclusion. No hedging is preferable because rupee receipt is highest. Now all of you, please read one more question. I will give you question number 13. Please read and solve question number 13. Cell practice part. Cell practice part. Read, think, and try to solve. Okay. This is a small question asked in RTP November 11. Jazz PLC. Jazz PLC, a UK company. So this time we will come out of India and go to UK. A UK company is in the process of negotiating an order amounting to euro 2.8 million. A UK company, and the order size is 2.8 million euro. Foreign currency is euro, home currency is pound, with a large German retailer on 6 months credit. If successful, this will be the first time Z has exported goods into a highly competitive German market. This is cell practice question 13, mark important. The ZAZ is considering following 3 alternatives for managing the transaction risk before the order is finalized. This is similar to cell practice number 1, but drafted in just a different manner. Mr. Peter, the marketing head, has suggested that in order to remove the transaction risk completely, ZAZ should invoice the German firm in sterling. So this is called home currency invoicing. Safest route. Let the other party convert euro into pound and make you the payment. And for invoicing in home currency, use the current euro per pound spot rate to calculate the invoice amount. Mr. Wilson, one more person, the CE, Chief Executive, is doubtful about Mr. Peter's proposal. CEO is saying that maybe the customer will not agree to that and suggested an alternative of invoicing the German firm in euro and using a forward contract to hedge the transaction risk. So he says, let us invoice in euro. Let us invoice in euro only, and we will take a forward cover. So option 2 is forward. Mr. Karan, CFO, is agreed with the proposal of Mr. Wilson to invoice the German first in euro. But, oh no, this is not Mr., this is Miss. How can I miss that? When Miss Karan, CFO, is agreed with the proposal of Mr. Wilson to invoice the German in euro, but she is of the opinion that ZAS should use sufficient 6 months sterling future contract to the nearest whole number to hedge the transaction risk. That means we should take future contract for hedging. Miss Karan is of the opinion that we should take future. Wilson is of the opinion we should take forward. Peter is of the opinion that home currency invoicing is better. Now let us solve. Following data is available. Spot rate dollar 1.1960, euro 1.1960, buying rate, and euro 1.1970 per pound. Now be careful, the rate is given for pound. The rate is per pound. The rate is per pound. You are an exporter. You will receive euro. You means the Z PLC, they will receive euro and they will convert euro into pound. So what bank will do? Bank will take euro from the customer and bank will sell them pound. So pound selling rate will be applicable, because bank is going to give Z PLC pound and take euro. Rates are quoted by the bank. Rates have to be read from bank's point of view. So what bank is doing? Bank is giving you euro. Bank is giving you pound, taking euro from you. So this rate is applicable. Now see the mistake in the question. It says 6 month forward premium. Here they have used the word premium and here they have used the term 0.60, 0.55 euro cents. So there is a problem. Should I give importance to this word premium or should I give importance to this rate which is in descending order? High, low format means discount. So I will give importance to this word premium and I will add these numbers to get the forward rates. 6 month future rate is currently euro 1.1943 per pound. So this is future rate. The important thing is future contract size is in pound and the spot rate and the 6 month future rate on maturity, this is maturity rate 1.1873 euro per pound. Calculate to the nearest pound the pound received for ZES PLC under each of the three proposal. In your opinion, which alternative would you consider to be the most appropriate? That alternative where the inflow is highest. So one by one, a similar problem was also discussed briefly earlier also. So now we will just focus on one more time understanding this kind of question. Similar question has been asked in the exam in November 2011 exam, RTP November 11, May 2020 RTP. Option 1, invoice in sterling. Option 1, invoice in sterling. Whenever you have a doubt which rate to apply, you have to draw this simple diagram, firm and bank. The firm will give euro to the bank because they are the exporter, they will receive euro, and then bank will give them pound. Rate for pound is given and bank is selling pound. So spot pound selling rate will applicable. Spot pound selling rate will be applicable. Write down invoicing in pound will produce. What is your invoice? The invoice is for 2.8 million euro, which we will write as 28 lakh. This is in euro and the rate is per pound. I will divide by euro 1.1970 per pound. So how much you are getting? Check the calculation. It is pound 2339181. Pound 2339181. So this is the answer under home currency invoicing. Then you write down alternative to use of forward contract. Use of forward contract. So we will add the swap points because premium is written there. We will add the swap points because premium is written there. So forward rate is equal to euro 1.1970. Again we will take the selling rate for pound and add in that the swap points 0.0055. Swap points are given in 2 digits, which means we are given 0.0055. So the forward rate will become 1.2025 euro per pound. Just for your understanding, write this note in bracket. Since the word premium was given, we have added the swap points to the spot rate. Now using this rate, I can convert the euro into pound. Next line, write down using forward market hedge. Sterling receipt would be using forward market hedge. Sterling receipt would be equal to, what is the invoice? 28 lakh. What is the forward rate? 1.2025. What is the amount you will get in pound? By converting at this rate, you will get pound 23,28,482 pound. 23,28,482 pound. So this is the answer under forward contract. What is important is future contract. So read the problem again. You will find that future contract lot size is given 62,500 pound, which means the future is available on pound, and then the future is currently trading at 1.1943 euro per pound. Invoice is in euro, so you have to first convert euro into equivalent amount in pound, then calculate the number of contracts, then gain or loss, then net amount received in pound. In this question, initial margin is not there, ignore. So again, I will give you 10 seconds to try. Come on. Give me the final answer under future contract. 10 seconds to you. Okay, 15 seconds. Okay, 20 seconds. Solve it like cell practice 1. It is a copy paste version of that. At least you should try. Now only. I could have given it as homework, but then what happens? Many students, they don't try. And these are important questions. likely questions in the exam for 8 marks. If you have practiced in advance, it is just a matter of writing there. You are a good student, please try. Calculate pound equivalent amount, calculate number of contracts, gain or loss, total amount available, convert into pound, that is the answer. No initial margin involved. Yes, have you done? I am coming to check your answer. Okay, now check the answer. Option 3, use of future contract. We'll write a note. UK firm has euro receivable. The UK firm has euro receivable. It is afraid of euro falling, that is pound rising. It is afraid of euro falling, that is pound rising. Futures are available for pound. Futures are available for pound. So buy pound future. So buy pound future. Because pound is expected to rise, you will take long position on pound future. Step 1, the equivalent sterling of the order, placed based on future price. So the equivalent sterling of the order placed is 28 lakh divided by 1.1943. 28 lakh divided by 1.1943. So what is your answer? 23,44,470. 23,44,470 is the pound equivalent of your receivable. So this is what we are trying to hedge. Then for that we have to calculate number of contracts. So step 2, number of contracts. Try yourself. Take the previous answer, divide by lot size. 62,500. So that you'll get 37.51. So you can round off to 38 contracts. No problem. 38 contracts is okay. Next is pound amount. Pound amount hedged by future contract. Pound amount hedged by future contract will be 38 into 62,500, 23,75,000. So this will be required for calculating the gain or loss. So actually we have taken a position on 23,75,000 pound. You can avoid also this step. In the next step directly you can calculate the gain or loss by multiplying 38 into 62,500. But if you want to understand better, this is okay. Right. Up to this, any query? What is the next line? Now I will come to maturity date. On maturity date, what happened? We have bought, think first, we have bought pound at what rate? 1.1943. And now on maturity date, we will sell pound at the future rate 1.1873. So it has gone down. So there will be loss. So we'll calculate the loss. Loss will be in terms of euro per pound. So your final answer will be in euro. So write down loss. the rate has gone down. Previously we took 3 or 4 questions where there was profit. Now we have taken questions where there are losses. You have to be careful with this step. Some exams they give profit, some exams they may give loss here. So 1.1943 is the rate at which we bought, and now we are squaring it off at a lower rate. So therefore the answer is 16,625 euro. If you want to write 23,75,000 full, write down. Otherwise you can write number of contracts into 62,500. Next line, write down step 4, total amount available after 6 months. Total amount available after 6 months. This loss means this is an outflow. I will receive from the customer how much? 2.8 million euro minus 16,625 euro loss on squaring of future. So I am left with now balance 27,83,375 euro. So step 4, total amount available after 6 months is euro 28 lakh minus euro 16,625. 27,83,375 euro. Step 5, pound inflow after 6 months. These euros I will convert into pound at spot rate at the end of 6 months. Spot rate at the end of 6 months. So write a note, euro 27,83,375 will be sold at the spot rate at the end of 6 months. At the end of 6 months. At the end of 6 months, the spot rate is 1.1873 euro per pound. This is euro, rate is per pound. We will divide. The answer is 2344 290 pound. 2344 290 pound. Now compare the 3 alternatives. Select that alternative where pound inflow is higher. Just select yourself. Write down the note yourself that this strategy is preferable. So the answer is decision option 3 is preferable. Option 3 in bracket, future contract. Future contract is preferable because pound receipt is highest. This answer is over. Now we'll take a break.